The market's going to crash. Is all this pessimism porn? Hello, this is Chart GPT today. Well, we get a lot of videos on how the market's going to crash. We're not going to make it to 2025. Things are going to go down the tubes. Look at all these people. Don't buy anything for 18 months. We can't make it past 2025. It seems to be a nice headline here. Jamie Dimon warning us about what's going to happen. I think this is the Harry Denton market to crash 92% this year. Oh dear. And the end of the U.S. empire. There's perennial Peter Schiff and doomsday. But is all this pessimism porn? Let's get into a little detail here and see if it makes any sense, looking at historical events. And of course, the past events is not necessarily a guarantee of future events, but it does make you wonder and pause. So let's see if these people are actually telling us the truth, or just all pessimism porn. So we're going to talk about yield curves here. Here's a 10-year, 3-month U.S. Treasury yield spread. Now, what this spread is trying to tell you, historically, whenever the spread goes negative, that means the nearby rates are higher than the longer dated maturities. It generally signals a recession. Now, a lot of people think, well, that recession is going to come immediately. Well, that's not necessarily so. For instance, usually here in the yield inversion back in 2006 and 7 happened for 530 days, and then the market crashed later on. So that's what happens. And of course, we're in a similar situation, 530 days more severe, and this could be signaling a recession. And we can see this historically over the past since the early 1920s when we had the big crash. The big crash was 600 days. You had the smallest one was 175 days. And of course, we talked about the 530, and now we're about around 531, 540 and counting. So this will be a very interesting scenario here. And the thing about it is here, we saw this inversion back in the 1929 crash. It was 600 days of yield inversion, but yet the markets continued to rise during that period for 2 years before the recession finally hit. And then boom, you see, we all know what happened in 1929. Here's kind of a scatter chart on all these different yield inversions, and there's I think the notes here at the bottom here is telling us, while the yield curve was inverted, economies and stocks and employment are all up. So just because we have a yield inversion, well, economy's fine. Well, that's not necessarily so, because it takes time. The severity of the eventual recession was signaled by the length of the inversion. So the longer the inversion, the more serious the recession becomes. We saw that in 175 days. It was a very mild recession back in the 1980s. And the length of time of the inversion is approximately the length of time the market continues to rally during the inversion, after the inversion period, and is of equal force in eventual downturn, meaning if you have a very long inversion period and it's very strong, then you'll see that same time frame that it takes. So right now, for instance, at 540 days of inversion, it'll take 540 days before the crash occurs. So if it would stop inverting today, that means the crash wouldn't even occur until another 145 days, which puts us in August 2025. That's assuming that the inversion stops. Of course, it may continue. So what's kind of causing all this? I mean, is it just technical analysis? Is it, if you look at the AI, you can check that out in the post link in the description box. Is it just self-fulfilling prophecy? People know that this has historically been the truth, so they make it happen, or is there something behind it? Of course, this is kind of indication. I show this video here, and this guy is typical. This is the economic advisor for Bidenomics, and you can see that these people have no clue. Let's take a quick listen.
Why does the government even borrow?
Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds, right? Since they sell bonds and people buy the bonds and lend them the money.
And of course, this is outrageous. So let's get into the fundamentals of this. Here again we mentioned the yield inverted curve was when the yield becomes inverted because the profit margins fall. Companies that borrow cash short-term rates and then lend at long-term rates, such as community banks, fail. Likewise, funds hedge funds are forced to take on increased risk in order to achieve their desired level of return. So they're the fundamentals of it. The inversion effects is stocks better than long-term yields, so stocks tend to go up, and it does lower inflation, which is what the Fed is trying to do. However, lower profits and future investment suffer, and since that is what will cause the eventual recession, which leads to lower growth, risk credit defaults, in the sense that there's over 300 banks that are on the watch list here that could fail over the next 12 to 18 months. And investors park their money in short-term rates. People don't want to invest in the long term because the low maturities, that's where people want to put their money. So that's kind of the fundamental effect, not just saying, well, here, technically this happened, but there's actual reality behind that as well. So here I just kind of put the explanation point on here. The S&P earnings have been in an earnings recession since this inversion started. You can see here the gold line, the kind of the brown line there. It's the earnings have not gone up, and so we can see that that means that companies can't be investing in the future, which is eventually going to cause the eventual rollover of the economy and cause the recession that we're all afraid of. So we're right here, kind of like we're similar to where we were in 2008. Will the Fed keep this inversion rates coming, or will they lower rates quicker? Or later they're worried about inflation. Some people are worried about deflation. Or will this inversion continue? Remember, if it continues up to 600, 700 days, that means the resulting crash could be big. So maybe those doomsdayers and pessimism porn is really telling you the truth. What do you think? Go to the post link in the description box and take our poll. Are people wallowing too much in pessimism porn? In the meantime, don't forget to subscribe.